Tesla is no longer judged as a bold experiment or a visionary outsider. It is judged as a system that must perform without pause. Every quarter, every announcement, every sentence spoken by Elon Musk now carries weight far beyond innovation. What once felt like momentum has slowly transformed into expectation, and expectation has a silent but relentless force. The market does not reward stories forever. At some point, stories must harden into numbers. This is where the pressure begins. For years, Tesla lived in a space few companies ever reached, a zone where belief outpaced reality. Investors did not just buy a stock, they bought into a future narrative. Electric dominance, autonomous driving, AI-powered transportation, energy ecosystems. A company positioned not just ahead of competitors but ahead of time itself. As long as that future felt closer every year, the pressure stayed invisible. Growth covered everything. Delays felt temporary. Missed targets felt strategic. But markets evolve, and so does patience. Today, Tesla stands at a different stage. It is no longer compared to what it used to be, but to what it promised to become. And that shift changes everything. Growth is no longer celebrated by default. It is inspected. Margins are no longer abstract. They are dissected. Every price cut, every production adjustment, every hint of slowing demand is read, not as a tactic, but as a signal. The story hasn't ended, but the tone has changed. What makes this moment fragile is not a single failure, but accumulation. Pressure builds quietly when expectations stack faster than results can resolve them. Tesla operates in an environment where slowing down is interpreted as weakness, but accelerating comes at a cost. Scaling production demands capital. Competing globally compresses margins. Innovation cycles shorten while public scrutiny intensifies. There is no room to pause, and that absence of pause is itself a risk. Elon Musk remains central to this equation, but not in the way he once was. His presence no longer amplifies confidence by default. Instead, it concentrates attention. Markets listen closely now, not for vision, but for reassurance. Words that once fueled excitement are now measured against balance sheets, delivery numbers, and long-term feasibility. The same voice that built belief now carries the responsibility of sustaining it under pressure. At the same time, the competitive landscape has changed. Tesla is no longer racing against inertia, but against capable, aggressive players who learned quickly. Electric vehicles are no longer a niche, they are contested ground. Governments, legacy manufacturers, and new entrants all apply their own forms of pressure, reshaping pricing power and consumer expectations. In this environment, dominance must be defended continuously, not declared. Yet the most important pressure is internal. Tesla is trapped between two identities. One is the company of disruption, built on speed, risk, and bold promises. The other is the company the market now demands, predictable, stable, endlessly scalable. Balancing those identities is not simple. Too much discipline erodes the myth. Too much risk alarms investors. The space between those extremes is narrow, and Tesla is walking it in real time. Nothing here suggests collapse. Nothing confirms failure. But the signals are no longer invisible. When a company reaches Tesla's scale, pressure stops being an event and becomes an atmosphere. It surrounds every decision. It shapes every reaction. And it raises a quiet question that no one wants to answer too early. Not whether Tesla can grow, but whether growth itself has become the weight it must now carry. For most companies, growth is the goal. For Tesla, growth has become a condition for survival. This distinction matters, because growth pursued by necessity behaves very differently from growth pursued by opportunity. What once felt like acceleration now feels like obligation. Tesla cannot simply grow at a healthy pace. It must grow fast enough to justify its past, its valuation, and the future it sold to the market years in advance. At scale, growth stops being linear. Each new unit produced carries less margin, more competition, and higher expectations. Tesla's aggressive price cuts over recent years illustrate this tension clearly. On the surface, they look like strategic moves to expand market share. Beneath that surface, they reveal something more fragile. Price cuts protect volume, but they compress margins. They defend dominance today while borrowing pressure from tomorrow. Growth continues, but its quality changes. This is where the trap forms. Slowing production risks, signaling weakness, maintaining speed risks, eroding profitability. Tesla operates in a narrow corridor where every option carries a trade-off that markets immediately react to. The company cannot retreat into a premium niche without abandoning its mass market ambitions. It cannot fully embrace mass market economics without being judged like a traditional automaker. Tesla exists between categories, and that in-between space is increasingly uncomfortable. Competition sharpens this dilemma. Legacy automakers have closed much of the technological gap, while new players enter with fewer legacy costs and aggressive pricing strategies. Electric vehicles are no longer defined by novelty. They are compared on range, price, software, reliability, and availability. In this environment, Tesla's early advantage no longer guarantees future dominance. Growth must now be defended on multiple fronts at once. Internally, scaling introduces its own risks. Expanding factories, global logistics, supply chain resilience, and workforce management all add layers of complexity that innovation alone cannot solve. Speed magnifies mistakes. A minor miscalculation at small scale becomes a structural problem at global scale. Growth amplifies both success and error, and Tesla is now large enough that errors echo loudly. What makes this situation particularly tense is that Tesla's valuation still reflects extraordinary expectations. The market is not pricing Tesla like a mature automaker. It is pricing Tesla like a technology platform with near-limitless upside. That gap between perception and operational reality creates pressure that cannot be escaped through volume alone. Growth is required not just to expand revenue, but to defend belief. This is why growth can become a trap. When growth is expected, it loses its power to reassure. Each quarter of expansion simply resets the bar higher. Anything less feels like decline, even if the company is objectively larger and more profitable than before. Tesla must outrun not its competitors, but its own past momentum. Few companies manage this transition smoothly. Elon Musk's vision of autonomy and AI looms over this moment. These promises function as a future release valve, a way to justify today's strain with tomorrow's transformation. But until those technologies deliver at scale, they remain narratives under construction. The market listens, but it also waits, and waiting creates pressure. None of this implies inevitability. Tesla still leads in many areas, still commands attention, still shapes the conversation. But growth is no longer a simple story of expansion. It has become a balancing act between volume and value, speed and stability, vision and execution. When growth becomes the only acceptable outcome, it stops being a strategy and starts becoming a constraint. This is the quiet risk Tesla faces now. Not collapse, not sudden failure, but entrapment inside its own success. A company moving forward at full speed, aware that slowing down could be more dangerous than continuing, even as the cost of continuing rises with every step. Every dominant company reaches a phase where problems no longer announce themselves loudly. They become quieter, harder to isolate, easier to rationalize. Tesla is now in that phase. The risks it faces are not hidden, but they are often softened by narrative, diluted by optimism, and postponed by belief in future breakthroughs. Silence does not mean absence of danger. It means danger has become normalized. One of the most underestimated cracks is expectation fatigue. For years, Tesla trained the market to think in leaps rather than steps. New factories, new models, new technologies, all presented as imminent. Over time, anticipation became part of the brand's value. But anticipation decays if delivery stretches too far. When timelines extend repeatedly, silence grows around the gap between promise and reality. The market does not panic immediately, it waits, and waiting changes sentiment slowly, almost invisibly. Another crack forms around operational transparency. As Tesla scales, its complexity increases, yet its communication remains heavily centralized around vision rather than detail. This worked when the company was smaller, and disruption itself explained volatility. At Tesla's current size, investors expect operational clarity, predictable execution, and measurable progress beyond ambition. When clarity does not increase alongside scale, uncertainty fills the space. Silence becomes a breeding ground for doubt. There is also the quiet tension between Tesla's identity as a mission-driven innovator and its behavior as a price-competitive manufacturer. Frequent price adjustments signal responsiveness, but they also signal instability. Customers hesitate, partners recalculate, competitors observe and adapt. Over time, price becomes the dominant message, overshadowing innovation. This shift happens gradually, not dramatically, which is why it is often ignored until it reshapes perception. Regulatory and geopolitical pressure adds another silent layer. As Tesla expands globally, it operates under more political, legal, and economic scrutiny. Supply chains depend on fragile balances. Incentives shift. Trade policies change. These forces rarely create instant shocks. Instead, they introduce friction, small delays, higher costs, slower approvals, each one manageable alone. Together, they quietly reshape momentum. Even Elon Musk's presence, once an unambiguous asset, has become more complex. His influence still attracts attention, but attention is no longer purely positive. Controversy introduces noise. Noise distracts from execution. The company remains structurally sound, but leadership focus becomes harder to quantify. Markets notice patterns before they react to events. Silence grows around questions no one wants to ask directly. What makes these cracks dangerous is not their size, but their alignment. When multiple small pressures point in the same direction, they create structural stress. None of them individually signal collapse. Together, they test resilience. Tesla does not face a single existential threat. It faces cumulative erosion of certainty, and certainty is the invisible fuel of valuation. The market often mistakes silence for stability. In reality, silence is the moment when systems recalibrate expectations quietly. Analysts adjust models. Long-term investors reassess conviction. Short-term traders look for confirmation. No dramatic headlines are required. The shift happens beneath the surface, visible only in tone, not numbers. Tesla's strength has always been its ability to redefine categories. The question now is whether it can redefine itself internally at the same pace. Scaling requires a different discipline than disruption. It rewards predictability more than audacity. That transition is psychologically difficult for companies built on momentum and belief. The silence around Tesla's cracks does not mean decline is inevitable. It means the next phase will be decided not by vision alone, but by execution under pressure. The louder the silence grows, the more important each action becomes. Tesla is still moving forward, but now, every step is measured not only by distance covered, but by stability maintained. Every pressure cycle ends with separation. Not everything fails, but not everything survives unchanged. For Tesla, the next phase will not be defined by sudden collapse or explosive success. It will be defined by selection. Which parts of the story endure, which promises convert into systems, and which expectations quietly fade away. The first thing that tends to break under sustained pressure is narrative elasticity. For years, Tesla's story could stretch endlessly into the future. New breakthroughs were always just ahead. Under pressure, narratives harden. The market demands fewer visions and more confirmations. This does not kill ambition, but it compresses it. Grand timelines lose power. Near-term execution becomes the currency of trust. What survives, almost always, is infrastructure. Tesla's global manufacturing footprint, software ecosystem, and data accumulation represent real, compounding assets. These systems do not disappear during downturns. They adapt, they slow, optimize, and consolidate. While headlines focus on volatility, infrastructure quietly continues doing what narratives cannot. It produces records and learns. Margins, however, remain vulnerable. In a competitive and price-sensitive environment, margins are the first-line sacrifice to defend volume. This trade-off rarely reverses quickly. Once consumers anchor to lower prices, regaining premium positioning becomes difficult. Tesla may maintain scale, but the profitability profile that once justified extraordinary valuation becomes harder to sustain. Survival does not always look like dominance. Autonomy and artificial intelligence remain the pivotal hinge. If Tesla successfully converts its data advantage into reliable, scalable autonomy, the story resets, not partially, but fundamentally. The company shifts from manufacturer to platform, but hinges work both ways. Delays or partial delivery do not destroy the vision, but they weaken its leverage. AI becomes either an accelerant or a stabilizer depending on timing. Leadership adaptation will be tested more than leadership charisma. In high-pressure phases, companies need less inspiration and more coordination. Systems over statements, process over personality. Tesla's culture was built for speed and disruption. The question now is whether it can evolve toward durability without losing momentum. That transition is rarely smooth. What does not break easily is attention. Tesla remains one of the most watched companies in the world. Attention sustains optionality. It attracts capital, talent, and partnership even in uncertain phases. But attention is double-edged. It amplifies mistakes as much as achievements. Under pressure, every decision becomes a signal, not just an action. The real outcome of pressure is not collapse, but compression. Possibilities narrow, strategies converge, extremes fade. Tesla will likely emerge more conventional in some areas and more focused in others. This is not failure. It is maturation under constraint. Many legendary companies pass through this phase quietly, only recognized in hindsight. What comes next is not a single event, but a sequence of confirmations. Small wins matter more than bold claims. Consistency outweighs surprise. Tesla's future will be decided less by what it announces and more by what it repeats successfully. Under pressure, repetition builds trust. The final truth is simple but uncomfortable. Tesla is no longer proving that electric vehicles can work. It is proving that belief can survive scale. Pressure does not ask whether the idea was brilliant. It asks whether the system can endure reality. What breaks will be excess narrative. What survives will be what was real all along.